Is the Vancouver real estate market on the verge of a major shift? From the continuing drops in mortgage rates to these economic fluctuations that we're seeing across the province and Canada-wide, as well as housing starts peaking, rental housing completions at an all-time high, where are we sitting when it comes to real estate and specifically real estate here in Vancouver? We're going to be talking about the future of housing supply, mortgage trends, and if this is the right time for you to finally make a move, whether you're buying or selling. My name is Kyle Mark, and like I said before, if you're buying, selling, investing, or relocating to my beautiful city of Vancouver, make sure you book that strategy call with me. It's in the description below. I'm super easy to get a hold of, and I am here to help. What I really like about the video today is that we're going to be going through a very advanced stat package of economic data that is really in depth and going to help you a lot when it comes to your due diligence of whether you are wanting to make moves within this Vancouver real estate market. So we're going to go into the mortgage trends, what we've been seeing across the board here in Vancouver. And I'm going to pull up some of these charts so that you can exactly see what I am seeing. So let's start with the mortgage market. According to the latest data from Canadian chartered banks, mortgage originations fell by 15% year over year in June, marking the steepest annual decline since early 2023. So what I mean by mortgage originations is essentially new mortgages being made available to new home buyers. We know that we've been in a state where sales are continuing to drop and there hasn't been an uptick in the movement across the market here in Vancouver. And we can see the data here very clearly with these mortgage origination volumes, as well as overall the mortgage originations on the 12-month rolling average. You can see that, in the pandemic levels, there was a massive run up in terms of mortgages. And you can see it's just been a free fall essentially since 2022. It has stopped around 2023 and flatlined since then. What's interesting is that while overall originations are down, there's been a slight uptick in variable rate mortgages as borrowers are anticipating further rate reductions over the course of 2024 and into 2025. The data that I am gleaning all of this from is the Edge report. It's a very comprehensive 27-page document, a bunch of economic details from immigration numbers to inflation numbers to mortgage originations as we're talking about now. And as I bring up the quote here, markets continue to reprice rate cut odds for this year and into 2025. Traders are now expecting cuts at every other meeting this year, with the overnight rate settling at 3.75% at year end. And then we've got potentially another 100 pounds or 1% of cuts through the first 9 months of 2025, so that by next year at this time, we'll see the Bank of Canada at 2.75%. So this is massive, and you can see the implied Bank of Canada policy rate path that is from January all the way to June of 2025, and that makes sense why these variable rates are starting to get more popular. People have gone through the pain, and now they want to gamble a little bit to see what they can do in terms of getting back some money in their pockets on a monthly basis. But keep in mind, when it comes down to the fixed market, and we can see that most new originations, however, are still locked into that 3 or 4 year fixed terms. As I bring this up on screen regarding fixed rates, with the steady stream of rate cuts now expected over the next year, the 5-year bond yield has plunged decidedly below the key 3% threshold. If it holds here, and there's no reason to think that it won't, it means another potential 0.5% drop in 5-year fixed rates. All else equals, that means we could see insurable deals well into the 3s, with an outside chance that uninsured could even break below the key 4% barrier. And that is massive. That is the one indicator that I'm looking at personally. I have 2 variable mortgage products right now that I'm looking to lock back into a fixed, but they haven't gotten to a point where I am happy with them right now. And when we are talking about the uninsured versus insured mortgages, it's very key for you to understand what that means. Any product that you are looking to get lending from that's under $1 million needs to be insured. Essentially, the bank is having an insurance policy out on you just in case you default. If you're going above the $1 million mark, you're putting a lot more down, a minimum of 20%. So the banks and the lenders have a little bit more safeguarding for themselves, and that is why they don't need you to insure those mortgages. But a lot of the growth and the originations that we are getting in the mortgage field are these insured mortgages. So anything under $1 million. And we know living here in Vancouver, that doesn't get you much. Those are all condo, maybe townhome prices in the Vancouver area. We're really needing these uninsured mortgages to start to drop. And if we see those uninsured mortgages on the fixed side drop to under 4%, I think we're going to start cooking big time and bringing a lot more competition into the marketplace. I know that with some recent census data, we saw that in Vancouver, an increase in population of 26.6 thousand people. So despite some of this interprovincial immigration and people leaving the city, there was growth year over year. We haven't seen a decline like we have seen in some cities across Canada. For myself, as I mentioned, I am wanting to see, for me, around that 4% rate for a fixed rate, uninsured. And if that is going to happen, that is where I'm going to be sliding myself into for those products, and we'll start to see some good savings, because I think even with the Bank of Canada dropping 3 more times, 25 basis points at a minimum up until January, you will still, I think, be a lot further ahead with those fixed rates, especially if you're hurting a little bit when it comes to easing some of those financial pressures. If we start to see some of these big changes in terms of mortgage rates and dropping both on the uninsured and insured side, and seeing some great numbers when it comes to variable and fixed rates, this report states that they can see a 10 to 20% uptick when it comes to sales across the country as a whole. I foresee something similar as well. I do think that by next spring, I think we'll be further enough along for people to start to get more comfortable with the current economic changes that we've seen and getting comfortable where the mortgage pricing is at. I think this fall market, good product is still going to move, but I think for a buyer, you're still going to have some opportunity. But I believe that by next spring is when things will start to take off again. What we're finding, and even though we've had the most amount of inventory around Vancouver for several years, we are still lacking good inventory. I have been working with buyers in the $3 to $4 million range in Burnaby specifically, and we haven't been able to find something. We've been looking for almost a year. There just isn't good inventory, even in that mid $2 million mark. This is again in Burnaby as well. We are just having a divide of good inventory, and when we have those good products, they are selling and moving quite quickly. When we start talking about housing starts and future supply, this is really crucial for anyone who's wanting to have a 5-year or so outlook of where the real estate market is going to go. Obviously, when we look at housing starts, rental starts, building permits issued, and when we start tracking some of that data, we can start to see where there's going to be some future log jams. So as we bring up some of the data here, and you can see that with this graph, it's showing the Canadian housing starts here. July saw a surprising 16% surge in housing starts across Canada. This was largely driven by a spike in rental unit construction, with rental starts outpacing both condos and single-family homes by the widest margin on record. And you can see here again, the rental market here is in the orange, single family in the blue, condo in the gray. And there's been a huge implementation, which we need for housing starts, rental housing starts across the country here. But you can see that depending on where you are wanting to go as a homeowner and where some of these log jams are going to be, the single family has been really dealt a blow. The condo market has stayed pretty stagnant the last little bit for the last several years. The July surge in starts was driven by the rental component, which jumped 58% year over year compared to a 2% increase in single family and a 22% decline in condos. So there is some cause to be concerned here, because yes, it's great bringing those rental numbers up, but if we start focusing on rental properties and not continuing the push for new product that can be purchased, then we start having these housing issues again with these log jams. They should be moving up in coordination together. One shouldn't be starting up by itself and the other one's falling behind, and we can see here with that data, that is exactly what is happening. When we look at these rental starts a little bit deeper, Ben from the Edge Report states, however, the surge is likely a one-off event. Developers were front-running changes to the CMHC's MLI Select program, and what this program was the Canadian Mortgage and Housing Corporation was providing loans to developers on a point system to help with these starts. So they were giving more advantageous terms to developers to incentivize them to build rentals instead of units for resale. So with this MLI Select program, which now makes financing new rental projects more challenging, as a result, forward-looking building permits have dropped sharply with a 19.8% decline in multi-unit construction intentions. So that is why we have to all look at all this data together to get a really good picture, because you can just see here, the great Krista Freeland stated in a tweet, Canada needs more homes. That's why we're going to help build 4 million more of them. Housing starts went up 16% in July. This is good news and a step towards putting home ownership back in reach for younger generations. But like I said, you can't just look at one piece of the puzzle. You have to step back and really see what is going on. When we talk about peak construction, likely we've hit a peak when it comes to construction activity for this cycle. Completions have been accelerating up 16% year over year over the past 3 months, but new starts are expected to slow significantly. And you can see exactly what I'm talking about here on this graph. You can see this huge spike here from 2023 onwards, and then it has just completely reversed. So that shows that there is going to begin to be a logjam. We can't have this yo-yo effect when it comes to projects, or there's going to be this continued start and stop when it comes to product, whether it's the rental market, which is much needed because we've seen over 8% year over year increase in rents across the country, as well as housing starts for resale as well. They need to flow in succession. If you're an investor or someone who's looking for a prognosis on the market over the next couple years, with all this data in play, it looks like we will have a big chokehold in 2028, and we could be facing another massive shortage in housing supply, particularly in the condo and single family segments. And I brought that graph up before, and we can see that they have stalled. This will set the stage for potential price increases down the line as demand outpaces supply once again. So we've done a good job finally getting all this product to market, but I think that was more in line with these interest rates. But as interest rates start to drop, housing starts to drop, permits drop, and now you have all these people wanting to come back into the market with these lower interest rates, it's going to start to create an issue. But it's going to take some time to remove this supply off the table. So this is not an imminent issue, but in the next year, 2 years, 3 years, we're going to start to see what the results of these decisions will be. We're going to jump into these inflation numbers now. We have the inflation data that came out last week, and it came in a CPI number of 2.5%, which is well below the 2.7% that was projected, which is great. We'll have the graph up here of the inflation in Canada, and you can see that, since 2020, from the pandemic, what that printing of money did to inflation in this country. It completely skyrocketed upwards to that 8% mark. We have now brought it down to that 2.5% level. We want to stay under that 3% level and stay in those mid twos. You can see that in and around that 2% mark is where Canada has been on average for the last 24 years. Keep in mind, these inflation numbers should actually be a lot better, and the Bank of Canada is in complete control of these inflation numbers. I know they like to put in the media that we need to do a better job and blaming this or blaming that for these inflation numbers, but really they can take control of these numbers. If we look at a graph here that is supplied, when you look at the composition of the CPI, which is the Consumer Price Index, the orange here is mortgage interest, and then the blue is everything else. If you would take away the mortgage interest, we're actually below 1.5%, and the mortgage interest is something that the Bank of Canada can control. If they would make more aggressive rate cuts, we would see those inflation numbers soar underneath that 2% marker, but they are unwilling to do that at this point. They're unwilling to ease some of the financial concerns for Canadians, and we are needing more significant rate drops to help stimulate this economy, because some of these other numbers, when it comes to jobs and unemployment and future unemployment and construction, there is going to be some pain here in Canada, and everyone here in the country needs to get some help, and that can be completely dealt with by the Bank of Canada being a little bit more aggressive. I want to take you over to Toronto, and this is a graph of condo completions in the Greater Toronto area, and right now the condo market is horrendous. You can't give condos away in Toronto. You can see that in 24 and 2025, all these massive condo completions teetering past 40,000, but as we stated, this is just Toronto, keep in mind. Upwards up until 2028, you can see that they drop. They are dropping almost 8 times to under 5,000 in 2028. So if you are an investor in Toronto, and I have great referral partners out in Toronto, make sure you get in touch with me, either book a call or shoot me an email or give me a call. Buying a condo in Toronto, I think would be a great investment right now. You can get some great pricing, and then you can see over the course of the next couple years, they are not going to be producing any condos. And then on the single family side, because we mentioned that condos and single family building permits are way down, the single family building permits here at the lowest levels that we've seen in almost 40 years. So that is also something to be concerned about. And for those who are looking at detached properties, especially in Vancouver, we already know the land use changes are going to continue to take away detached homes, putting multiplexes in. If you own dirt and full lots, you are going to be doing very, very well. For all you investors out there, or even if you are a tenant and you're watching this video, thank you for your support. As we get into the rental market and future trends, I'm going to bring up this new housing completion graph. And the orange here is purpose-built rental completions for 2024, and we are seeing nearly 80,000 new purpose-built rental units delivered in the past year across Canada, which is great. We know that, and I've been seeing it because I've had to fill a couple of my rentals here in Vancouver. The rental market is starting to soften a little bit. There's not as much competition. I'm not getting as many applications. I know other landlords are feeling the same, and I think it is due in part, and you can see, to some of these rental startups happening, being able to ease the tension here in the market for Vancouver, which is fantastic, which needs to be done. Vancouverites and other people across Canada, a lot more selection when it comes to rentals. A lot of these units are new, and giving people access to more options in housing is something that we've all needed across Canada. So that is something great. If you are a skilled trades worker and in the labor markets, this is something that you need to look at as well. And we've highlighted already that yes, we've seen a peak of these housing starts, and that is a pause for concern for people in the skilled trades. And you can see here on this dwellings under construction graph here, we have stagnated, and this is across Canada for the last couple years. And what the issue being is we've always had a shortage of skilled trades here in Canada, and now we've gotten to a position where we may not have enough work for skilled laborers across the board in the next little bit. And we can see that, for example, in Ontario is the leading indicator here. Construction employment has already declined 8% off the 2022 highs, and it's down 5% year over year, a decline historically consistent with prior recessions. Ben goes on from the Edge report stating that he thinks the issue will intensify in coming quarters and spreads to other provinces as well. That is something to be concerned about, no doubt. For myself, I spent 11 years in the trades. Blue collar work and skilled trade and laborers are a backbone of this country. So it is really imperative that the government here moving forward can come up with a plan that can push all these types of housing, from rental to resale, from single family to multiplexes, all together in a nice uniform way. We know that under this Liberal government that has not taken place. Perhaps next October, hopefully earlier than that, with a change of government, a change of people in the office, start to really tend to these issues that we're having here in Canada and pricing. So how do we tie all of this together? How does this affect you in Vancouver and pricing across the board? You can see that with some of this data here, and from the inflation numbers coming down, mortgage rates coming down. So how do we tie all of this in together? We know that housing is a huge issue for people not only here in Vancouver but across Canada, and that pricing is so extremely high, and the only solution to that is to bring more supply to the market, as well as bringing in more jobs for people that pay higher. And something that I want to leave you with, and these are Canadian home prices in the global context. So there's the real house pricing graph here, as well as the price income ratios and price rent ratios here. So what this shows is essentially Canada, unfortunately, is on the top of the pack in all three of these dynamics. And this shows that with real house pricing, we are by far the most expensive place to live when it comes to countries that we are compared with in terms of the UK, France, Australia, the US, Spain, Ireland, Germany, Italy, and Japan. And we have the price income ratio here, and essentially that is your personal earnings in comparison to housing pricing. And this shows how unaffordable things are getting here in Canada. It started around 2010 when we started to really break out and have a country where wages are not keeping in line with housing. And then we have the price rent ratios, and this is for people who are working and how much they are making in comparison to the rents that they are paying. And you can see that Canada, yes, we've been down tracking in all three of these categories, but we should not be at the top. We're so well above the average. The average in all these these graphs are in the black. So what does this mean for you? We know that in the midterm, inflation is coming down, interest on mortgages are coming down, and that there's a big supply of inventory. We also know that moving forward in the next few years, that there is going to be a supply crunch. So in Vancouver specifically, we know that we have a lot of product, but we don't have good product. If you are a seller and you have a good layout in a good location, a good area of town, you're going to be able to sell your home and still sell it quite quickly. There's still homes that are selling within the first week. If you have a little bit more challenging property, or your price expectations are just not in line with the market, you're going to have some issues selling those homes. But I think for a buyer, from the buyer perspective, you have some time up until the spring, I think, to get some good value if you're patient and you're not emotional. For a first-time home buyer, that is great. You're just trying to get in while you can, make a good purchase and get some equity. If you're a seller and you have some time, if you really want to take advantage of a good market, perhaps waiting till spring, especially if you have to do some things around the house, landscaping, decluttering, painting, you have some time to get things set forward. I do think the spring market starting up here in the next couple weeks will be strong. September 4th is the next Bank of Canada policy rate announcement. There's going to be another drop in rate. So eventually, this momentum of these rate drops are going to start to snowball. In any case, if you're needing more information, book that strategy call with me. It's in the description below. Let me help you with your real estate goals, and we can partner together for success for whatever that looks like in each one of your individual cases. My name is Kyle Mark, your Vancouver realtor, and whether you're looking to buy, sell, invest, or relocate to my beautiful city, Vancouver, I am here to help you every step of the way. Take care.